Interest rates are down, governments are introducing major incentives to make new homes more affordable, and Ottawa still has people who need housing. So why does the real estate market feel so slow? Because when you look beneath the headline numbers, something interesting is happening. Through July 2026, Ottawa sales are down 5.2% compared to this time last year. And at the same time, new listings are up 4.5%. And the average number of active listings is up a staggering 14%. So think about how all three of these numbers and what they mean together. More homeowners are trying to sell, fewer buyers are actually buying, and the homes that don't sell accumulate. And that's why months of inventory has risen from 2.9 months of inventory last year to 3.5 months of inventory this year. And homes are taking longer to sell. So today, rather than just giving you another Ottawa real estate market update, I want to go a little bit deeper. Why is this happening? Why hasn't lower interest rates produced stronger housing recovery? And why are some property types holding up considerably better than others? What role could the economy, employment, and government housing incentives be playing? And most importantly, what should buyers, sellers, and investors be watching as we head into the fall real estate market? My name is Mark Belanger, and my goal with all of these videos is always the same: better information, better decisions, and hopefully better outcomes. So let's get into it. Let's start with the month of July, because if I gave you only one number, you'd probably think the Ottawa market was doing relatively well. There were 1,325 residential sales in July. That's actually up slightly from a year ago. Nothing alarming from here specifically. But now let's look at the inventory. Ottawa had 4,678 active listings at the end of July. That's 9.3% more than a year ago. And months of inventory moved from 3.2 to 3.5. And the median days on market went from 24 days to 28 days. So here's the important distinction. Homes are still selling. The issue is that the buyers have considerably more to choose from. And when supply grows faster than demand, the market changes. A buyer who might have had 3 reasonable options now have 6 options to choose from. So they don't need to rush. They can compare, they can obviously negotiate, and they can walk away from a property that they didn't like. And sellers are increasingly competing against each of those specific buyers. That's what I mean when I say that the issue right now is really about absorption. How quickly is the market absorbing the homes being listed for sale? And when you look at the year to date, the answer becomes clearer. Through July, sales are down 5.2%. New listings are up 4.5%, and the active listings are up 14%. The sales to new listings ratio has fallen from 51% a year ago to 46% this year. So more product is entering the market than buyers are absorbing, and that's the first big story. Now, this is where we need to be careful because it's very easy to hear more inventory, fewer sales, longer selling times, and we conclude that the prices must be collapsing. But they're not, at least not across the entire Ottawa market. The MLS Home Price Index Composite benchmark price in July was about $634,000. That's only about 0.5% lower than at this time last year. And the benchmark for single-family homes was around $725,000, which is actually 0.6% higher than a year ago. So what we're really seeing isn't necessarily a broad collapse in value. We're seeing something obviously a little bit more subtle. Buyers have gained leverage faster than the prices have fallen, and that's an important distinction. A slower market doesn't automatically mean that every house becomes dramatically cheaper. Sometimes it means the house takes longer to sell. The seller accepts less than their original asking price. Conditions return to offers. Negotiation matters again, and buyers simply have more time to make decisions. That appears much closer to the Ottawa market that we're seeing today. And this may be the most important part of the entire update. So when people say How's the Ottawa real estate market? My answer, as usual, is what part of the Ottawa real estate market are you referring to? Because as you know, detached homes, townhouses, and condos are all behaving a little bit differently. So let's start with detached homes. In July, single-family sales actually increased 5% compared to this time last year. New listings were actually flat. Active listings are only up 3.4%, and single-family benchmark price was slightly higher year over year. That's not an especially weak market. It's certainly slower than the extraordinary pandemic years, but detached housing is showing some actual resilience. Now, let's compare that with townhouses. Townhouse sales declined 4.1% in the month of July. Active townhouse listings increased 21%, and months of inventory moved from 2.4 to 3 months. And the median townhouse price was down 5.3% year over year. Now, let's look at the apartments or the condos. Apartment sales were down 6.6% in July. There were 5.4 months of inventory compared to 4.6 a year ago, and median days on market increased to 41 days, and the median apartment price was down 5.1% from last July. So year to date, apartment sales are down even more, 14.2%. And here's the part that I find especially interesting. The HPI benchmark for a townhouse is down approximately 5% from a year ago. The apartment benchmark is down approximately another 5.2%. The single-family benchmark is up slightly. So Ottawa isn't experiencing one uniform housing market. There appears to be a real divide developing between the housing types. And that raises an interesting question. Why are some of the more affordable housing categories actually weaker than detached homes? So hold that thought for a second, because we're going to come back to it in just a second. And for the last several years, we've had a very convenient explanation for housing weakness. Interest rates, and clearly interest rates mattered enormously. When mortgage payments rise dramatically, affordability falls, and that's basic economics. But here's the problem with using interest rates as an entire explanation today. The Bank of Canada policy rate is now 2.25%. And in its July monetary policy report, the bank said Canada's economy remains weak, but is beginning to show signs of improvement. And at the same time, it said uncertainty remains elevated. So, if borrowing conditions have improved substantially from its peak, why hasn't the housing demand surged? And I think that tells us something pretty important. Being able to afford a house and feeling confident enough to buy the house are not exactly the same thing. So think about that. Let's say you're buying a $700,000 home today. You're not asking or simply asking, what is my mortgage payment? You're also asking, is my job secure? What happens to the economy? Will home prices fall? Will rates change again? Can I sell my existing home, which is obviously a pretty nuanced question? Am I comfortable taking on this much debt? What if I wait another 6 months? And all of these questions affect demand, which leads me to a working hypothesis. Housing affordability may be improving faster than housing confidence. That's very different. And it's one of the things that I think we need to watch carefully. All right, and this is an Ottawa channel, and Ottawa isn't just another Canadian city. I go through this all the time. We have a very unique employment base. The federal government and the businesses connected to the government represent an important part of the local economy. We also have technology, professional services, healthcare, education, and many other public sectors. But when there is uncertainty around government employment, government spending, or hiring, that can potentially affect consumer psychology in Ottawa differently than obviously in any other city. And I want to be very careful here. I'm not saying that public sector uncertainty caused the housing slowdown. The housing statistics don't prove that, but it is absolutely something worth watching because real estate decisions are deeply connected to employment confidence. If you're wondering whether your household income will look the same in the next 6 to 12 months from now, you're probably less likely to make a major financial commitment today. And nationally, the labor market hasn't exactly been booming. StatsCan reported a 6.5% national unemployment rate in June, while Ottawa's unemployment rate was hovering around 7%. So unemployment and consumer confidence belong in our fall housing watch list, not because it'll tell us exactly what will happen, but because housing demand ultimately comes from households that feel secure enough to act on it. All right, so let's go back to condos for just a second, because I think this particular segment is actually telling us something. The Ottawa apartment benchmark price is now around $385,000, which is down about 5% year over year. And more interestingly, it's down approximately 9% over the last 3 years. That's very different from detached homes. So why? And as I said, I don't think there's one specific answer. It could be some sort of a combination of the condo fees, investor demand, rental economics, available inventory, buyer preferences for freehold housing. I hear that one all the time. Competition from new construction. And yes, there's a ton of new construction. Affordability, or simply the fact that buyers don't feel urgency when there are so many available options on the market today. And this is another reason why broad market statistics can be very misleading. Imagine that there's a homeowner with a detached home in some sort of desirable neighborhood, and another owner who owns a downtown condo, and another owner in a suburban townhouse. All three might ask me, Mark, what's happening with the Ottawa home prices? And the honest answer could be different for each and every one of those three examples, because your real estate market isn't Ottawa or the broader Ottawa market. Your real estate market is the specific market competing with your property. And that's why neighborhood, housing type, price point, and competition matter so much. So now we get to the question that everybody really cares about. What's going to happen in September and in October, the fall market, the second best market of the season? And I'll give you the answer that may not make a very good sensational headline. And here it is. I don't know, and neither does anyone else, but we can identify the things that will determine the answer. So here's the 5 signals that I'm watching closely, and so should you. Number 1 is employment. Do Ottawa households feel more secure about their jobs and their income? That's the question. If employment confidence improves, that can release some pent-up housing demand. If uncertainty increases, buyers may continue waiting. Number 2, interest rates. The Bank of Canada is currently at 2.25%. Do borrowing costs improve any further? Or do inflation concerns limit additional relief? Rates matter, but as we've already seen, they're clearly not the only variable. Number 3, inventory. This can be the most important real estate statistic. I watch inventory all the time. Active inventory is already significantly higher than this time last year. If sellers continue listing faster than the buyers are purchasing, inventory grows, and sellers compete harder. And if buyers return to absorb that inventory, the balance changes quickly. So watch the inventory closely. Come back every single month and watch that particular trend. And number 4, sales. July sales were essentially flat compared with July of last year, and detached sales actually increased about 5%. So that's pretty interesting, because it's possible July is simply another slow month, but it's also possible that we're beginning to see stabilization beneath year-to-date weakness. 1 month isn't enough evidence, so August, September, and October will tell us considerably more. And 5, confidence. And this one doesn't fit neatly into an MLS spreadsheet, but it matters. Do people believe the economy is improving? Do they feel secure? Are buyers worried about that prices will fall? Or do they begin to worry that waiting could cost them an opportunity? Housing markets are driven by numbers, but they're also driven by human behavior, and confidence changes behavior. Let's turn this into something useful. If you're thinking about selling this fall, don't assume the market will rescue an unrealistic price. Buyers today have choices. Homes are taking longer to sell, and the sale to list ratio is below 100%, and inventory is higher. That makes pricing and positioning much more important. And I've said this before, hope is not a strategy, and this market reinforces it. Your asking price should be supported by current market conditions, comparable sales, current competition, and the specific characteristics of your home, not by what your neighbor sold for 3 years ago, and not what the highest number somebody is willing to tell you at the kitchen table. There are still buyers, but sellers have to earn their attention. And for buyers, the environment is much more interesting. You have something buyers didn't consistently have during the pandemic years, and that's time and choice, and in many situations, negotiation leverage. And that doesn't mean that you should be automatically going out to make lowball offers on absolutely everything. A well-priced detached home in a great neighborhood may still attract strong interest. And remember, detached sales were actually higher this July. But when a property has been sitting for 30, 40, and 50 days, and there are 5 competing homes in the area in the nearby vicinity, that's useful information. And you may be able to negotiate price, conditions, closing date, repairs, or terms that would have been much harder to negotiate a few years ago. The opportunity isn't simply homes are cheaper. The opportunity may be buyers can make better decisions. And I think that's more valuable. Investors should probably stop thinking about the Ottawa market as one investment, because it isn't. A downtown condo, a suburban townhouse, a detached property with a secondary dwelling unit, a duplex, a new construction investment, they can all respond very differently to the same economy. And right now, the widening performance gap between property types is a reminder that you need to understand the very basics. Your entry price, your carrying costs, the rent, the condo fees, the vacancy risks, the future supply, the neighborhood demand, the financing, and your investment time horizon. Don't buy something simply because you think Ottawa real estate always goes up. That's not investment analysis. That, my friends, is hope. So where does that leave us heading into the fall? I don't think the July statistics tell us that Ottawa real estate is collapsing. They don't. Prices overall have been relatively stable, and detached housing has shown some resilience. But the statistics do tell us something important. Supply has been growing faster than demand. Homes are taking longer to sell. Buyers have more options. Townhouses and condos are considerably softer than detached homes. And despite lower interest rates and significant government incentives, buyers remain cautious. Why? Probably not because of one specific thing. Housing markets rarely work that way. However, interest rates matter, affordability matters, employment matters, government policy matters, inventory matters, and consumer confidence matters. So rather than trying to predict exactly where Ottawa home prices will be 3 months from now, here's what I'm going to do. I'm going to watch for the evidence. Employment statistics, interest rates, inventory, sales, and consumer confidence. And as those things change, we'll adjust the strategy, because good real estate decisions aren't about pretending we can predict the future. They're about understanding the information that we have today and making the best decision that we can with it. My name is Mark Belanger, and if you're thinking about buying, selling, or investing in Ottawa, and you'd like to talk through what these market conditions really mean specifically for you, you'll find my contact details below. And in the next video, we're going to take this market and make it tangible. I'm going to show you what approximately $750,000 actually buys you in different parts of Ottawa right now. Different neighborhoods, different housing styles, and even different investment options. So watch out for that specific video. It should be pretty interesting. So thank you very much for watching. I look forward to putting these videos together on a weekly basis. So until the next video, stay smart, stay invested, and I'll see you in the next video.